Hello, degenerate rippers! It is Degen Rips here, back with another Investor Series video, where I'm going to be responding to our good friend Geoff Wilson's video yesterday, where he indicated that the sports card bottom is here or will be here soon, and I'm going to talk a bit about my thoughts, and I'm going to back it up with some charts. But, Geoff's video yesterday, he said, stars and Hall of Famers will always hold value. There's a long history to show that. And I agree. I think he's right. I think guys like Tom Brady, Michael Jordan, Kobe, there's always going to be a market. People are always going to want their cards. And they're going to hold value. Mickey Mantle, same. Jackie Robinson, Babe Ruth will always hold value, will always be a good hedge against inflation. So I agree with him there. But then he goes on this tangent about how the overly negative sentiment going into this year, 2023, is a reason why we should be optimistic that the contrarians are going to win. And if everyone's negative, that means the market has to bounce. I kind of disagree with that. And another thing he says is because the prices of some cards, such as LeBron James rookie cards, are reaching their pre-pandemic prices, the late 2019 prices, it means that the bottom is almost in. I once again disagree with that. I'll show you why. The economic environment's a lot different. But let's get into this. I hope you guys enjoy. So one of Geoff's main arguments was that because sentiment is so low in the sports card market and everyone is very pessimistic, it must mean that a bottom is near. Well, here is the cryptocurrency fear and greed index. And this goes back to a year ago, and 100 on the chart indicates extreme greed, 0 means extreme fear, and a year ago we were at extreme fear in the cryptocurrency market. And guess what happened? Over the next year after that, the market has gone down another 65% for a year. So extreme fear does not indicate a bottom is in. It does not even indicate a bottom is near. Sentiment can remain very low for an extended period of time. There's no reason that just because most people are fearful that it indicates a market bottom is in. Ultimately, what does sway the sports card market is the Federal Reserve, that unelected group of people that just are probably more powerful than Congress and the President of the United States. But anyway, that's for another video. But so, as you can see, the federal funds rate right now, interest rates, are double what they were at the peak before the pandemic. So Geoff's argument that because sports cards are back to where they were, maybe some of them before, where they were late 2019, that means that the bottom is in. That's definitely not the case here. It could be, but likely not. The interest rates were half of what they were now. So I'm going to get into a chart right now that shows how the federal funds rate set by the Federal Reserve moves the sports card market, and we're going to draw comparisons to 2008 recession and what happened after that, before that, what the markets were looking like, and that should give us a rough idea of where we're heading and when we can actually expect a bottom. Now let's take a look at my super scientific chart that I totally didn't make in 5 minutes in Microsoft Paint. But this is the sports card market, the modern sports card market from the years 2004 to 2010. You can see 2004 rates were 0 and the Fed began to hike. And from the beginning of the hike to the end, we saw a 20% collapse in the sports card market. And then we had our recession, interest cuts began, and then when interest rates finally hit 0, and obviously you can't really go any lower than 0, so that indicated the bottom in the stock market, it indicated the bottom in the sports card market, and then we took off from there. So let's take it a bit slower and go phase by phase. So think of things today. Just a year ago, the Federal Reserve started to hike rates to combat inflation. Think of that as 2004. We get our rate hikes and the market tanks, more than 20%. You add the pandemic, things were a little different. People were home, more people got involved in sports cards, stimulus checks, you know the deal. So the interest rate hikes began, and we saw a huge pullback in the markets. Cash became king. People weren't borrowing as much. People weren't spending as much. And then you could see we went into a recession in the beginning, or the end of 2007 on this chart. We went into a recession. And when we get to a recession, that is what indicates, okay, the rate hikes are done. We need to stimulate the economy. And the Federal Reserve starts to cut rates. But when rates are being cut, that does not indicate a bottom in the markets. As you can see, the markets keep falling. The markets don't bottom until the rate hikes are done. And that is when the Federal Reserve says, okay, we're done. We're going to leave rates at this level until we see the economy is moving in the right direction, and they don't hike, they don't decrease rates, they leave it at wherever. In this case, it was 0. They left it at 0. They said, that's it. We're leaving it at 0 for an extended period of time. And that was that. So when the Fed is done cutting rates, that is when the market went into a decade-long bull run. And yeah, the rest was history. So where are we right now on this chart? I said we're in between right now, rate hikes happening and the recession beginning. So the yield curve is inverted, and that's always indicated a recession is coming. A lot of economists think a recession's coming in the next year or so. And, I personally think there's a recession that is going to happen in the next year or so. And once that recession happens, that is when we could start speculating when a bottom is coming. You want to wait for the signal for the Fed to cut rates, because if rates are going to keep rising, which the Fed has said, they're going to keep hiking rates, so we can expect more hikes. That doesn't indicate to me a bottom is in or even close to being in. So once we get our recession, and I don't know when that'll be, I just assume it's going to be within the next year or so. And once that happens, the Fed starts cutting rates. That's when we could start, putting the pieces together. Okay, they're cutting rates at this rate, that rate. And it doesn't happen overnight where rates go to 0 or they bottom out and the Fed hits their target. That's another process that could take 6 months to a year to get back down to where the economy is stimulated, and this is where the Fed wants to keep rates for an extended period of time. So just to wrap things up, here's just a quick picture of the overall football market. You can see playoffs, nothing really moves the market. It's just been in a slow downtrend. And that's going to keep happening until, like I said, we get our recession. The Fed says, okay, it's time to stimulate the economy. We're going to cut rates. And then once rates hit the Fed's target to the downside, whether it be 0, 0.1, whatever, once we get to the Fed's target to the downside, and it can't go any lower, that is when the sports card market bottoms. And when is that going to happen? I don't know. But to say that's going to happen soon, like within the next 6 months soon, I think that's just a pipe dream. And I just have to disagree with Geoff Wilson there. Geoff, he makes good points. He sounds like he knows what he's talking about, but I just have to disagree. Let me know what you guys think in the comments. Do you think the bottom is soon? Do you think what I'm saying is just a bunch of hoopla and it only really applies to the stock market and not the sports card market? Let me know. I really love your feedback. Thank you all for watching. I really appreciate it. Thumbs it up, subscribe, and yeah, I want your thoughts. Peace.
Agent rips with his fingertips. He'll go broke by the end of this.